It's 9 a.m. in Beijing and Hong Kong. Welcome to Bloomberg Markets China Open. I'm Annabelle Droulers with Yvonne.
Our top stories this morning: the Chinese leadership reportedly convening a key meeting to discuss the country's 2024 growth target and its economic plans. Asian stocks moving higher ahead of U.S. inflation data and major central bank meetings. Chinese stocks, meanwhile, coming off a late Monday rebound amid speculation of state buying. And President Xi Jinping is set to make his first visit to Vietnam in 6 years in a bid to counter U.S. influence. So the fact that he's heading to Hanoi, what does that tell you about these meetings that, reportedly are maybe wrapping up a little bit, right? And what does it tell you about where the path of policy is going to go? But certainly we got to talk about this reversal in stocks that we saw in the afternoon.
Yeah, it was really the big activity because yesterday the CSI 300 touching that fresh year-to-date low. So a lot of lack of conviction really coming through in market activity. But it was that late rebound that came through, not really signaled explicitly, of course. We know that China doesn't really indicate to us that it's really going into buying the markets. But there was trading activity in a specific ETF that tracks SOEs, and that saw a huge spike coming toward the end of the day. The big question, of course, does the rebound have any sort of staying power?
Yeah. And obviously, you take a look at the market. It didn't really completely lift the whole market, but certainly we did see at least we bounced back from that new year-to-date low, as Belle mentioned. Whether we're going to see more signs of that today is another story, of course. Of course, we talk about the backdrop right now. We're counting down to the inflation numbers in the U.S. We're counting down to the Fed the following day after. There's not a whole lot of buying or conviction in these markets right now.
No, you just saw, pretty much no action coming through in the Treasury space. I took a look at trading volumes, for instance, before. They're well off the 20-day moving averages at this point in the session. Where you're really seeing the action so far, though, you can see here in these chip stocks. You've got the Japan names at the top, bottom two, Taiwan just coming online here today. So we saw the Philadelphia SOX index, for instance, advancing in the prior session. Broadcom upgraded by Citi on its AI potential. So that's really the key sector we're seeing so far that's seeing any sort of movement or trading activity. Quick check on China futures here. You're still seeing that positivity coming through, but the question is still, Chinese stocks, are they nearing a bottom? There's certainly a lot of technical indicators we're tracking as well.
Yep, that certainly is going to be the. Everyone thought maybe last month might have been the bottom, but then again, the data basically has disappointed up until now as well. Let's find out more about this rebound because we talked about this specific SOE ETF. If we could fire it up right now to show the surge in volume that we saw towards the early afternoon or towards the end of the close, and maybe this is a sign that there is something going on, right? And of course, officials reportedly beginning their annual economic work conference. Joining us now in a roundtable is our economy editor, Jill Deesis, and our Asia equities reporter, Charlotte Yang. Charlotte, I'll start with you. Is this something that, we've been anticipating, finally, maybe some intervention in these markets?
Yeah, so there are chatters yesterday with that, sudden sharp recovery we saw with CSI 300, and that coincides with this trading activity pickup in this ETF called China Southern CSI Guoxin Central SO ETF. People have been trading. Sorry, it's a long name.
Mouthful.
Yes, it's an ETF people are trading because, watching closely because China Reform Holdings earlier this month have said one unit of this company has bought an unspecified amount of this ETF. So these has been seen as, whether if there's a spike in trading activity, we might see state buying. But, with state buying, you only get confirmations usually after the market or through state media or through their filings from the institution themselves. So we don't really know for sure. But, another thing is whether this has staying power. We saw it with earlier this month, December 1st, we had similar form of state buying. That time was confirmed, but it didn't really stay long as markets now are still very much focused on economic recovery and with the disappointing data over the weekend with CPI. So sentiment is still pretty much weak.
So where are you expecting then stocks to close by the end of the year? Is the momentum going to be moving a bit higher or further trend lower?
I feel like people in the street are very afraid of giving any target right now. But I think one thing is sure is that the Central Economic Work Conference is what everybody's watching, given we didn't have so much clue from the Politburo meeting readout. And, with the Reuters report saying the meeting is actually happening, I think people will be watching if we get any readout or any signals coming out from it.
And they look like, Jill, they might be setting some ambitious targets for growth next year.
Yes. And I think, Charlotte makes a good point, which is that what you ultimately want out of this economic work conference that's reportedly happening right now is some kind of specifics, right? I don't really know that we're going to get a specific growth target out of China right now. Normally, they announce that in March when they hold their critical 2 sessions meeting. But a lot of the chatter is about whether or not they're going to be really, really aggressive, more pro-growth with that 2024 target. We would expect that to be somewhere around 5% year-on-year growth, which is what they targeted this year. Obviously, earlier this year, a lot of economists were thinking maybe that's a little bit too conservative, just given where growth came in 2022. But at this point, I mean, if we're going to end 2023 with growth at or above 5%, that does mark a pretty ambitious target, which would have to necessitate, more fiscal spending, a stronger support on that side. So I think anything that we get out of this conference, if it wraps today, if it wraps this week, that gives us specifics on how they're actually going to get there with that kind of a growth target would be, I think, really beneficial for the markets to understand.
Yeah, you mentioned the policies, and we do have a lot of pressure really coming onto the fiscal side, given the monetary one can't do that much at this point in time. What exactly would you expect to see out of it in terms of any sort of concrete actions?
Yes, well, I think that at this point, I don't know that you're going to get like a ton of specifics as to how they're actually going to get there, but I think anything that indicates maybe they're going to, raise their deficit to GDP ratio going into next year. There's a lot of speculation about maybe they'll finally push above that 3% limit that the government is generally held to, indicating that there's going to be more fiscal spending on the part of the central government. I think that would be really big. I think any indication that there's going to be additional issuance of sovereign debt to sort of help, especially a lot of these debt-laden local governments would be really, helpful for everybody else to understand. So I think if you're getting anything like that, maybe, even on the monetary side, if you sort of bring back some of those, redevelopment programs that they were doing back in 2015, 2016 to sort of help the economy, I think that any indication whatsoever that that's what the government is considering for 2024, that would give us at least a bit of an understanding about how they might achieve those more aggressive targets.
And it seems like, Charlotte, these markets can't catch a break right now, but then there is one part of the market that's defying the sell-off. It's these small caps, this Beijing Exchange 50. What's going on there?
It's a lot of sentiment there, but I think one thing to note is, it's also a lot of small caps, and it's also a lot of sentiment driven. As no onshore, people need to find new things that excite them, and there has been a lot of activities with the Beijing Stock Exchange. But I think one thing to know is that market is even more dominated by fast money and super fast money. So it's really like we're talking about even maybe days move whenever the shift that change.
How closely then, Jill, do you think that officials in Beijing are sort of tracking these stock market moves as an indication perhaps of international sentiment, and they really need to shore up that activity?
I mean, I think they've been tracking them all year, right? Yeah. I mean, we've seen elements of, an intervention in the past to sort of help buoy market sentiment. You even saw in the Politburo readout on Friday, I know that it was pretty disappointing for investors to look at that and not see any kind of concrete action. But there was like one line in there indicating that foreign sentiment, foreign investment is important for this government. There's obviously been a really, really big push on the part of, top leaders, including Xi Jinping, throughout this year, saying that they need to shore up foreign sentiment. So I do think that they're very keenly looking at those market moves. I'd also just point out, remember, we've had various press conferences throughout the last year or so that seemed really geared toward trying to spur investors, trying to make them, excited about this market. Obviously, not much has really worked, but I do think that they're paying attention.
All right, yeah, not enough to attract back the foreign investors. Okay, Jill Deeses, thanks very much for your time. That was our China economy editor, and also Charlotte Yang, our Asia equities reporter as well. And we'll have more on all of this ahead, because we're going to be speaking with the Hang Seng Bank China chief economist Dan Wang, joining us later to look at China's deflation challenge and what more the government can do about this situation.
Yep, and we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. We talked about it's quite quiet as we talk about inflation numbers of the U.S. coming out later on here tonight. Futures, though, are pointing positive. We're up about 0.1%. This is Bloomberg Markets, China Open. Good morning.
Yes, it's end of cycle, and that means one of two things. It means a hard landing, or it means that we're going to have some new exogenous shock or driver for positive growth. Okay, the kind of status quo of decelerating growth, falling inflation, typically is not good for equity. So the no landing scenario was always kind of a fantasy. Okay, it has to be one or the other. It has to be either hard landing or it has to be a reacceleration of growth. And, right now, the first half of the year probably feels more like a hard landing still. And then maybe in the second half, we can get a broadening out.
That was the Morgan Stanley chief U.S. equity strategist and CIO Mike Wilson on the outlook there for U.S. earnings. And, of course, someone we know who's been pretty bearish over the course of this year.
So he's still talking about, the recession risks out there and all that. And I think you take a look at what we're seeing in terms of the inflation data ahead of the CPI print. It still continues to show disinflation, right? You take a look at the short-term inflation expectations. These are the 1 year, according to the New York Fed. That fell to 3.36%. So in some cases, does add to the case that maybe we will achieve some sort of soft landing. And then we'll see, right, whether that headline print estimated at 3.1% later on today. And that's, of course, ahead of the Fed. Let's bring in Jonathan Liang, head of Asia ex-Japan investment specialist at JP Morgan Asset Management. The markets are pricing in different scenarios right now. I take a look at stocks and where yields are ticking up a little bit higher again. Maybe that means soft landing. But then I look at oil prices. I look at gold prices near records. That seems to be sending growth concerns. Which part of the market is right?
Well, we think growth is definitely going to slow down, but whether it's a soft landing or recession, I think the jury is still out. We are of the opinion that eventually it will be a recession. There are leading indicators that are suggesting that. Right? So one of the things that a lot of investors look at is that when the yield curve inverts, that is supposed to signal a recession is coming. But the timing of when that actually happens is actually when the yield curve inverts, right, and steepens again. So we almost got that a couple of weeks ago, but then now it's inverted again. So, we think that when the soft landing narrative really takes hold and the yield curve steepens back up to positive territory, that's when a recession is going to hit.
Is that a sort of message, though, that the Fed is going to want to push back on in its meeting later this week because the market has been so agitating for rate cuts?
Yes, they will definitely push back on that narrative. So right now, if we look at market pricing, the market's pricing about 4 cuts next year. And if you look at the dot plots, I mean, originally there was supposed to be 1 more hike tomorrow, but then 2 cuts next year, according to the dot plots. But we're not going to get a hike tomorrow. So that means that there may be 1 cut next year. So that's a pretty big divergence between the market and the Fed. The Fed is going to try to sound very hawkish to try to push back on that.
Okay. It leads to a lot of questions about how hard they're going to push back against it, right? Because the data does show that things are slowing down.
Yeah, and there's the dot plots, I think, as well, because you're going to get an updated set of those. So do you think that is something that could really be really, again, change significantly, or something that could really shock the markets if it isn't?
It's possible, but, if they remove December's hike and then they keep next year's, then that means that's 1 cut next year, and maybe that's what they will do. But we think that they're going to point to the still very strong labor markets as a reason why they're not ready to cut yet. And, the latest non-farm payroll print, 199,000 jobs, that's still very robust. So they'll use that to say that, we're not ready to cut just yet.
So in terms of direction of travel for yields, where does that leave you? If you think it's just 1 more cut, 1 cut next year, you're saying, instead versus the 4 to 5 the market's pricing in right now?
Well, we think what's going to happen is that there will be no cuts in the first half of this next year.
Okay.
And then things will really start to slow down because right now rates are really in restrictive territory. But inflation, by whatever certain gauges, we're at 2% plus, 3%. And policy rates at 5.5%, call it. That's very restrictive, and that is slowing the economy down. We're starting to see cracks in the lower end of U.S. households. Delinquencies and auto loans have climbed to 20-year highs.
Yeah.
So corporate default rates are slowly rising, and we think that layoffs are probably going to be just around the corner. And then at that point, they can't point to the strong labor market anymore, and that's when they'll cut. But that might be the second half of next year.
So when it comes to your investment strategy then in that sort of environment, when it comes to owning duration, do you still see the 5-year as the sweet spot of the curve?
We do. We think the 5-year gives you a right balance of some yield and some duration, importantly, because we do think that as the economy slows down in the first half of next year, that rates will move down even before the Fed cuts. The bond market is forward-looking. So, but then, because the yield curve is still inverted, you don't want to be too long duration. And so we think 5-year is a sweet spot in the yield curve. However, we also like certain sectors in fixed income. Agency mortgage-backed securities are trading at wides. We last saw during the global financial crisis. you're getting almost like investment-grade corporate type yields, but with U.S. government-backed paper.
Yeah.
So that's a really good deal.
What about EM right now? I mean, we've seen some parts of EM already begin their rate cutting cycles. What does that mean for local currency bonds?
It means that returns are going to be pretty good. In fact, EM local currency debt this year is one of the best performing fixed income markets, and we do think they still have room to run next year. Maybe not every single one, right? But select countries that have been very early in their rate hikes, where their countries are running very high real yields.
Yeah.
We think that they're going to have much more room to cut, and if the market believes the Fed is done, therefore currency, FX side, will also do well in the local currency side.
I know you don't track the BOJ, but given, again, talking about policy changes, policy normalization from the Bank of Japan is going to be a key theme over the course of 2024. How is that also playing into your thinking?
Yeah, so a couple of things. So they've effectively given up yield curve control. Now it's when do they hike the short-term policy rate, and we think that happens probably in first quarter of next year. Now, importantly for treasuries, though, right, because we've got quite a bit of supply coming down the pipe, and we've got two major buyers that may buy less going forward. China is not really buying treasuries anymore. Japan, if their yield curve normalizes, suddenly domestic Japanese investors have a domestic investment option where they don't have to go over to the U.S. They're still buying at this point, but looking ahead into the future, when the Japanese curve normalizes, that could affect the U.S. Treasury market.
How high does that JGB yield have to be to spark that sort of repatriation? I mean, are you forecasting any sort of scenarios in your head? I mean, does it have to be 1% for the 10-year or higher to really get that sort of flow back into Japan now?
It doesn't just depend on BOJ. It also depends on the Fed.
Sure.
Right? So if the Fed's cutting and the BOJ is hiking and the differential starts to narrow, I think some domestic institutions are going to start to repatriate assets back to Japan.
What about the ECB? Because, of course, they've got their rate decision this week as well. Last time you spoke to us, you didn't have a lot of conviction around the European debt market. Are you having any sort of changes there in your planning or strategy?
For the ECB, we think they might be the first one to cut because their economy is in much weaker shape than the United States. And recently we did have Isabel Schnabel come out to say that, no more rate hikes at least, and not push back on a rate cut in the first half of next year. So given and inflation is trending very low in Europe, and their labor markets, the only thing that might be stopping them is that there is some major unions wage negotiations that's happening in the first quarter of next year. But we think that given the economic weakness and the very rapidly declining inflation, that they could cut as soon as the first quarter of next year.
First quarter of next year, okay.
First quarter next year.
How do you position around the bond market there then? I mean, did you have a bit more conviction around bonds? I mean, obviously, we have the budget concerns that we talked about a few weeks ago as well.
Well, the government bond market has repriced quite quickly as they sort of realize that the 4% may be the peak in Europe. We think that one area within Europe, there's a couple of areas that we like. We like European high yield, select European high yield. There's some sectors we're staying away from. But valuations, when you hedge it back to U.S. dollars, European high yield is now cheaper than U.S. high yield. Another area that we do like is, this one's a little technical, we like European swap spreads.
Okay.
Yeah, so basically we're buying European agency debt and then hedging out the duration with swaps.
Oh, wow.
And just isolating that spread, which is the only area in the fixed income world that's screaming cheap today is European swap spreads and agency mortgage-backed securities.
Okay, great.
Right. Jonathan, thanks very much for your time this morning. That was Jonathan Liang, Head of Investment Specialist Asia ex-Japan at JP Morgan Asset Management. And just recapping as well, the yuan fix that dropped a couple of minutes ago, but coming in a little bit stronger than the estimate there. The reading on that 7.1174 versus the estimate of 7.1762. The offshore yuan as well, just a little bit firmer off the back. And plenty more ahead. This is Bloomberg.
All right, if you're thinking about whether we're seeing signs of a bottom in Chinese stocks just yet, here's one indication that perhaps we're not quite there yet. I mean, at least sentiment is so bad right now. Can it get any worse? You look at the breadth of this market here right now, and we're tracking this line here in white, which basically are stocks and the percentage of members that are above now that 200-day moving average. So that's slowly coming down. But really, it's been actually lower in previous bouts before. So are you seeing signs of capitulation just yet? Perhaps not, just given just the percentage here right now. And you look at it, there's similar ways of looking at it, whether it's, the 52-week lows of some of these stocks, the RSIs, they're below 30. It's basically painting a similar picture that maybe perhaps we haven't gone to those extreme levels just yet, Belle, when it comes to this market. So at least there's some hope here that maybe the risk reward when it comes to really raising your exposure in China could be a bit more attractive now.
Yeah, but it's really that big question because we've seen a number of different false bottoms over the course of this year, and those overarching issues are just continuing to persist. And one of them, of course, is the property sector front and center, because Bank of America are out with a new call this morning, and they're saying that the issues and the problems that are plaguing real estate are really going to be persisting. They're not seeing a quick resolution. In fact, and it's something we were speaking about yesterday as well, this is going to be a multi-year recovery time frame. Off the back of that as well, they're saying that's going to really hit deals in the real estate sector. So not really expecting too many transactions outbound or inbound over the course of 2024. Beijing, of course, really trying to show up confidence.
Yeah, we'll see if this whole ETF buying and what traders are telling us will continue here. We're in that window still for credit data, so we'll see if the data that we're seeing in November gets any more bad than it has already been. Real lending rates, given the deflation, really, you're starting to see that spike up here as well. Leaning with that buyback. We'll watch how those shares are going. Chip stocks and liquor stocks as well. A lot of movement on Liaozhou here on maybe reports of price cuts there. And of course, Xi Jinping heading into Vietnam later on this afternoon. Watching chip stocks in particular. One we're watching is China Lit here as well on a plan to buy Tencent assets. We're seeing the stock up some 6% in the pre-market. We got the open coming up next. This is Bloomberg.
You're watching Bloomberg Markets China Open. We're counting down to the start of trading for mainland equities, Hong Kong shares as well. And the outlook that we're seeing in futures so far, just ahead of the open here, a little bit mixed in the session. But really the big question yesterday was whether we saw the national team starting to come in and prop up sentiment once again.
Yeah, we're watching this SOE ETF very closely here, whether we do see some sort of state buying. We certainly saw that late day reversal. Looks like, at least in the Hang Seng, we're continuing on and being in positive territory for now. But we're talking about marginal gains here at the moment, because the Politburo meeting seemed to be the disappointment. Then you had the deflation numbers, or the inflation numbers, I should say, still pointed to deflation in the economy. So not a whole lot of good news out there. This work conference that's happening right now, does that be the inflection point for these markets if we hear anything more concrete, right? We just heard from our very own Jill Dees. Maybe not, concrete action, so to speak, though, but certainly we'll see anything when it comes to the growth target. There's a lot of reports whether that is going to be hit in 5% or not. Is that a sign that maybe this recovery can get back on track in 2024? CSI 300 is doing this here right now. We're about a third of % lower. We did hit a new year-to-date low on Monday before we saw that surge in activity in the late as part of the session. So 3,347 was what we had reached at one point. Hang Seng is slightly lower here as well. We're flat when it comes to MSCI China. But you look at what's really catching a bit here. It's HS Tech, and it's also a little bit here. It is the crude markets and metals. So iron ore is also catching a bit here. Real estate is actually doing quite well. The CSI 300 real estate index is up some 2% as well. The BI gauge also up some 1%. And we're watching very closely what happens with these chip stocks. We have the Philadelphia Semiconductor Index that hit some multi-year highs as well. But also Gina Raimondo, the Commerce Secretary of the U.S., talking about, maybe some more breakthroughs in terms of how to talk about the Huawei situation, strongest action after that Huawei breakthrough, I should say. So that's one to watch very closely here. So leaning that one, after the news that they were going to buy these 2 units in Hong Kong, we're seeing a bit of recovery in the stocks. So they announced this buyback. They're not bond buyback, but buyback. And we're watching some of these Huawei sort of suppliers like SMIC series not doing a whole lot here right now. And we're talking about Laozhou. This stock was flying at one point on reports that they might be cutting their prices. No movement on the stock here today. And we're watching that one just flash into your screens there, China Literature. So we're watching very closely here that they are buying some Tencent assets here. That certainly is going to be helping the stock. There you go. We're now up 10% on that stock after they did announce, I think it was Tencent Animation and Comics.
Well, as you mentioned, Yvonne, you were just saying there that report that we got from Reuters, the China Central Economic Work Conference could be underway, and something that market participants are going to be watching very closely. Any sort of clues on the outlook for monetary, fiscal, various industrial policies over the course of next year? Let's discuss that now and bring in Dan Wong. She is the chief economist at Hang Seng Bank China. Dan, thanks for joining us this morning. This Central Economic Work Conference, it could possibly be underway, could be concluding as well today, so we can possibly expect some news out of this. What would you be expecting to hear?
Well, the market has paid so much less attention to the Central Economic Work Conference this year than last year. One main reason is that last year's pledge, most of them were actually not carried through. Like the government talk about prioritizing consumption or prioritizing private sector, none of them went through. So this year, the one thing that people watch the most closely is the economic target. Many people say it'll probably be 5% again. We believe it will be lower than that. 4.5% is probably a more realistic one, but even that is very hard to achieve.
Why not 5%, Dan Wong? I mean, what would it actually take for China to deliver on around 5% target next year?
Well, China can deliver. Even now, we have seen that the government has approved multiple projects that were previously disapproved, including the high-speed railways, data centers, and water projects in central and western China. So reaching the target is not really a problem. But issue is the difference between the macro data and the micro perception. This is openly acknowledged by the National Bureau of Statistics. They know that those growths didn't translate into people's income. So for the next year, the 5% target again, it will be fine. But then people won't feel happy. And the one thing the government cannot do is that you cannot force people to be happy.
I think what you say there as well really plays into the borrowing costs that we're seeing as well in China, because real borrowing costs are expected to stay really elevated into 2024. I think we've got a chart here taking a look at our calculations, but rates right now topping 4%. They could be even closer to 5%. So that's the highest level we've seen since 2016. How is that also playing into that growth story or lack of growth?
Well, the high real interest rate mainly apply to the private sector, especially small and micro borrowers. For those businesses, they have very little alternatives. And for the SOEs, they can usually borrow at a 2% nominal interest rate from the market, from the commercial banks. But for those smaller businesses in the private sector, they usually still borrow at a rate around 8 to 12% in nominal rate. So that has added to the cost of their business operation, and that means the private sector rebound will be even slower. And I also believe that the high real interest rate is one thing that also deters foreign investment. If you invest in overseas market, the risk-free interest rate is basically 5%. But in China, the difference between the GDP growth and the expected return in operating a business is just simply too high. So it is not a good sign for the economic rebound.
And it just goes to show that maybe China may stay in deflation, a little bit longer, right, Dan? Well, I'm just wondering, given the print that we saw over the weekend, how bad is this whole deflation concern now? I mean, how entrenched is this sort of deflation picture? Is it mostly in the property market, or where else are we seeing it in the economy?
The price decline is has been quite persistent for over a year now. And at this point, it's not just a decrease in residential home prices, it's also a decrease in the general consumer price. On the macro level, it's probably a bit counterintuitive. The lower the price is, the lower the consumption will be. especially when it comes to durable goods. If the prices of EVs and housing are going down, people will postpone their consumption. They don't just rush in and buy it. So now this downward spiral is already there. Actually, from economic perspective, the government really has to try hard to blow up the inflation, no matter what. They could print out more money, they could lower interest rate, they should have done that quickly. But for whatever reason, they're not doing it. And I believe this price decline pressure is going to persist well into 2024.
Do you have any sort of idea of when we'd see the bottoming in those price pressures? What sort of targets are you looking at for that? And you mentioned as well the sorts of response we'd start to need to see from the government. What can we really expect here to try and reinvigorate price pressures?
The government, I still believe that they have to lower interest rates, albeit in small and lagging fashion. And in 2024, there probably has to be more fiscal expansion, and much of that money will have to be supported by the central bank. So the inflation is essentially a monetary phenomenon. So the government has to print out more money, and they also need to find more projects to do. And at this point, I have to say, China's economy is more and more like a command economy. The government pick the industries, they pick the companies they want to support. But ultimately, you need to find new demand in order to boost the consumption, in order to boost investment. And that is ultimately the driver for inflation. And so far, they cannot do much for domestic market. So they're trying very hard to find overseas market.
So, Dan, do you think we've reached a bottom in the economy? I mean, it seems like we thought that bottom at least, was reached a few weeks ago in the third quarter, but the data is just turning sour again. Have we reached a bottom? And if so, what are some of the indications that you're looking at that perhaps, growth is going to bounce back? Do I look at, lending activity? Do I look at home sales to bounce back first? Which are the first indicators that you track?
I will look at actually infrastructure spending. For home sales, it will stay quite weak, not just in the coming month, but probably in the coming years. So for the real driver for the economy, it has to be state-led, because the private investors are just too reluctant to spend. And in the fourth quarter, I actually believe it will be the best performed quarter this year. Because many of the major projects start to take place. And the central government is also taking over more debt from the local government. That means probably the local projects can start again, including the city renovation or the Shantytown renovation. So it's not too gloomy. The real question, though, is how the government will deal with the housing market in 2024. It probably will stay quite depressed. But there has to be some measures trying to boost housing sales. So far, I haven't seen any, but hopefully they will discuss this in the World Conference.
Yeah, what sort of measures would you be looking at? Because, for instance, we just had a call out earlier from Bank of America saying that the property slump is going to be lasting for years, and it's going to be something that's going to have also a spill-on effect, for instance, to the deal-making sector as well.
Well, that is very true, I have to say, because if we're talking about home prices, I don't think it has reached the bottom yet. The government tried to have this controlled decline in residential home prices, and the equilibrium probably is still another 3 to 5 years to go. And for the home transactions, it has a lot to do with the economic outlook and also population growth. And we know in many of the Chinese cities, they are losing population. And economic structure is not sophisticated enough to support the housing price to rebound. So for the government, they're now relying on the construction of state housing, the low-cost rental housing or affordable housing. But these are not really comparable in scale when it comes to commercial housing replacement. So a lot of attention is also focused on developing other industries like the EV supply chain. But then again, that relies on the overseas market rather than the domestic market when it comes to growth.
Dan Wang, great to have you. See you next year, chief economist at Hang Seng Bank, China. Taking a look when it comes to these markets here, we're still seeing some pressure when it comes to Shanghai and, of course, onshore markets here this morning. Hong Kong's doing a little bit better in the face of all that. So you are seeing about 0.5% to the upside when it comes to the Hang Seng. HS Tech, that's slightly lifting things here. We're seeing that gauge up some more than 1% here. We got plenty more ahead. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Chinese President Xi Jinping is visiting Vietnam for the first time in 6 years for a 2-day trip seen as a bid to counter U.S. influence in the Indo-Pacific. Let's get more now from our Asia government and economy correspondent, Rebecca Chung-Wilkins. What are we expecting in this trip?
Well, it's worth noting, too, that this is Xi Jinping's only trip to another Asian nation this year. And it is significant that he's chosen Vietnam because really what's at stake is, for both China and the US, this shifting balance of power in the Indo-Pacific. And Xi Jinping's trip follows this trip by Biden to Vietnam, where he did leave with quite a handful of different deals, everything from semi to conductors, trade, economic deals, and the US IPEF, Indo-Pacific Economic Framework, in play as well. So for Xi, there will be this pressure to deliver something to show the sort of strength of China's hand in Vietnam. China does have this sort of long-standing, albeit quite complex, relationship with Vietnam. And as Vietnam becomes increasingly this player that other countries in the West, in the US and its allies try and kind of seek and jostle for power, China too will see increasingly trying to exert that same kind of influence.
So what kind of economic carrots then could we expect from China to Vietnam, given what came out of the US meeting with Vietnam?
Economic elements obviously on the forefront there, potentially on trade that we could see. And we also have this potential railway links that would, China helping to sort of construct and build those railway links as well. So that might be something. The BRI is still, although we've seen it somewhat underplayed, in analysis, but actually it's still a big sort of and the key format for China to roll out. So potentially more on the BRI front as well.
Vietnam, they seem to be playing both sides, right? I think it's this whole bamboo diplomacy. How are they navigating between these two in some ways?
Yeah, I think that's a really interesting element here. Vietnam has managed to strike this very delicate balance between, on the one hand, this seemingly a new partner for the US to rely on, but the other hand, also being able to sort of stay on good terms with Xi Jinping. And it's worth noting, even just right at this moment when we are seeing these confrontations between the Philippines and China in the South China Sea, right in Vietnam's backyard. Despite that, Vietnam too also has these disputed claims, rival claims to China in that part of the world. And so Vietnam in a way is a model for a country that has managed to try and strike that balance. But it is increasingly the case that we are seeing the lines in which the world are being divided. The Philippines leaning increasingly closer to its partners in the US, particularly when we see that confrontation. And the US also, of course, supplying support for some of that activity that is happening in the South China Sea too. So for China, one of the emphases here will be to try and urge Vietnam, privately at least, potentially perhaps not publicly, but privately at least, urge Vietnam not to engage and to pull back and not to sort of join in the fray and add to those complexities.
So what sort of assurances then do you think Vietnam's going to be sort of seeking from China in that case?
Certainly on the military front, it is a long-standing issue, has always been the case because of these sort of disputed territories. And China has been able to manage all of those contested claims for so long. But really, we have seen that start to shift, particularly with the Philippines being much more publicly confrontational, also broadcasting a lot more, for example, what these types of incidents actually look like at sea. And there is this fear of, rising risk of some kind of accidental conflict too. And so Vietnam may also be seeking reassurances about those kinds of issues between fishing boats, for example, and other kind of, boats that are in the area.
All right, Rebecca, thank you. Rebecca Chung-Wilkins, our Asia government and economy correspondent. Some of the top corporate stories that we're tracking for you today. U.S. Commerce Secretary Gina Raimondo says Washington will take, quote, the strongest possible action to protect its national security after a recent chip breakthrough by Huawei. She would not confirm a formal investigation is underway into the Chinese giant and its chip-making partner, SMIC. The Bureau of Industry and Security earlier said it is looking into the purported 7-nanometer chip unveiled in a Huawei smartphone back in August. A jury in California has ruled that Google's mobile app store maintain a monopoly in the Android app distribution and payments market. The ruling could potentially jeopardize billions of dollars of revenue generated by its app store. The move deals a blow to the tech giant in its antitrust battle with Epic Games, which sued Google 3 years ago. Microsoft is teaming up with labor unions to create an open dialogue on how AI will impact workers. Under the partnership, the tech giant will provide training on how artificial intelligence works and gather feedback from certain sectors. This marks the first formal collaboration on AI between the tech industry and unions amid concerns it could displace workers. We got plenty more ahead. This is Bloomberg. Well, Chinese health authorities are saying that they are seeing a fluctuating downtrend when it comes to respiratory illnesses among children. That's after a recent outbreak sparked concerns that a novel virus could be the culprit. But doctors are now saying that the real danger lies in the rise of superbugs, boosted by years of drug resistance. For more, let's bring in our senior medical reporter, Michelle Cortez. You may remember her. She used to cover COVID for us for a long time. Can you talk us a bit more about this drug resistance that we're seeing in China? Why is this all happening now?
So there's a couple of things that have been happening for years and years in China and many other places, but particularly in China, antibiotics are overused. People get a cold, they go to the doctor will prescribe an antibiotic, even though there really is no benefit from the antibiotic. The child will just get better over time, but resistance can potentially develop. So that is what's happening in the background. What's happened specifically in this particular case is a lot of children were born during COVID. There were young babies during COVID, weren't exposed to all the germs that you would normally see over the course of young life. These kids have been particularly hard hit by this, what would be potentially a normal wave of infection. We saw it across the world, but in China, there is this intensity to get your children treated right away. Parents will bring their doctors to the hospital, even for what seemingly in other places might be considered a mild infection, and not getting the response and having your child get worse over time. It can be really terrifying when you're a parent.
Yeah. So you're saying there's a cultural aspect as well that's at play in this, why China was so particularly hard hit?
Yeah, absolutely. I think that parents in China just aren't really willing to let an infection run its course. Let's see how it goes. And so there's twofold impact of that. You can see drug development or drug resistance developing as a result of overuse of these antibiotics, but also the parents aren't as willing to just let those kids get worse over time. Not get worse, but just, an illness run its normal course. And that's a difficult thing. Also, treatment is much more aggressive. You get intravenous antibiotics often in China, whereas in the U.S., you're not going to give that to a child unless there is something truly seriously wrong.
At least the numbers of cases are coming down. I mean, that's an encouraging sign right now. Is that likely to be a trend that we can see for the rest of the winter season?
Yeah, hopefully. Again, that's part of the issue, right? We're going into the colder winter months. People are concerned. We saw that, with influenza all these years, not so much for COVID. But there is the hope that we're going to see these numbers coming down. Certainly the possibility as people go inside for more cold weather activities, we'll see an increase. The interesting thing is that we're seeing these cases pop up in other parts of the world. There was a lot of concern that it was coming out of China, that something had happened. Maybe there was a superbug that had been developed there, not a novel pathogen, which of course brought all the COVID flashbacks, but maybe just a really aggressive new form of, drug-resistant bug. But it seems to not be the case, and we're seeing normal infections like this pop up in the U.S. and in Europe and other places as well now.
All right, Michelle Cortez, thanks very much for your time this morning. That was Bloomberg senior medical reporter joining us. But checking now, of course, on what's happening in market action. We're just about 25 minutes into the session so far for mainland and Hong Kong equities. And some green here on the screen this morning. So you've got the chip developer, chip company SMIC, for instance, that's surging. But of course, we saw those big gains in the Philadelphia Semiconductor Index overnight. Poly Real Estate, another one, jumping after unveiling a share buyback plan. So up as much as 6% in the session so far, looking to buy 1 to 2 billion yuan of shares in the next 3 months. Tencent, China Literature, we're also focusing on Yvonne, that huge surge there.
Yes, they're buying Tencent Animation and Comics. I didn't even know Tencent had a comics unit, but they're buying it. And that's really lifting this. It's flying. We're up about 14%. They're around the session highs now. This one continues to gain. And Tencent is also catching a bit here as well. And it's really that tech space that is lifting the boats here when it comes to the Hang Seng. HS Tech is up close to 2%. Iron ore is catching a bid once again. And we're seeing a lot of green when it comes to the real estate sector here. Perhaps it's the Poly news as well that maybe, that could signal some sort of inflection point or at least some sort of bottom in these markets. We got coming up, Stand Chart telling us about gold heading after, after all these all-time highs that we saw. We're talking about COMAC as well.